Hey everybody, this is David Skrika. So today's stock chart of the day, this is Wednesday, or sorry, Thursday, the 6th, I think, of March. We're going to be looking at a sector that actually broke out recently, and a very important sector, and a sector that I don't think if we were to enter a bear market here, we are going to see this sector breaking out right now. So I think this is kind of like the whole thing with the broadening of the rally, et cetera, et cetera. So this is the BKX, the banking sector. And we can see here, after declining, having the correction with the rest of the market into late October, where it fell from 88 to 72, it's rallied all the way up. It broke through those summer highs in December, and then it broke through the recent high here just over the last few days. Now we'll go get a longer term chart, and it's not quite as high. We'll get a 2-year chart because you remember these banks really got hit last year when that regional banking crisis happened. But look, the BKX high there was about 115, and it went to 72, and now it's back to 98. So you can see this here. So we've actually, if you take it like from where we started to gap down, it was around like 102. So we're not that far away. And I just think that, look, if we're going to see some kind of major declines markets, we're overbought. Can we see a correction here? Sure, fine. But I just think if the banks are breaking out here, it's a good sign that probably the health of the market is still pretty strong, and we will continue to probably rally as the Fed rate, cuts rate. Sorry. So let's look at some of the banks here. We'll look at Bank of America. You can see the breakout there in Bank of America. Bank of America is actually now kind of where it was pre that regional banking crisis last year. We look at Goldman Sachs. You can see the same thing. Goldman Sachs actually near all-time highs, or highs for this move. What's the other one? Let's go look at JP Morgan. Similar, like JP Morgan is completely taken off. You can see JP Morgan has gone from 135 to nearly 190, even with Jamie Dimon selling a bunch of shares. Now, of course, we know the regional banks have really tanked recently, and there's a bank out of New York Bank Corp, that really fell hard, and the regional banks, look at the regional banks out right now. Yeah, there's a KRX. But you can see their decline is not been too huge, even with that, and they remain above their 200-day moving average. They'll continue to lag. And when you understand one issue with the regional banks right now is that they really can't afford these higher deposit rates. They loaned out too much money, too cheap. They're down on these assets. They're down on the bonds they bought. They issued too much debt to loan out that money. So they can't keep up. So they will benefit the most from rates, say, being cut from ultimately 5.5% to, say, I don't know, 3.5, 3, because then there'll be less demand for these higher deposit rates, and that's put less stress on them. So I would actually look for them at some point here to really begin to outperform the large cap banks. And if we go look, when rates were zero, that's when the regional banks performed very, very well, because they didn't really have, they can make all kinds of loans. Regional banks tend to be more volatile, obviously, than the larger banks, and they didn't have any stress on having to pay out deposits. But now what's happening is on top of all those bad loans or assets going down in price, they have money leaving, because people are like, well, you're only paying 2-3% on this deposit, and I can get 5% in the treasury. So they've seen assets leave. And of course, in the fractional banking system, whatever, $1 in a bank account controls $10 worth of loans for the bank. So they can't go out, and they can't even take advantage of higher rates by making loans, because they're having assets leaving. So they're in this bad bind right now. And I think Fed cutting rates will really help them. So just to summarize, and don't worry, the Fed watches all this stuff. They know this stuff. So they know, the U.S. has too much interest on its debt. The rates have to go down, blah, blah, blah. That's why they're not going to be worried about inflation going back down to 2%. So I just this is today's stock chart of the day. I just wanted to talk about the banks and just say, look, if we are really to enter a bear market, look, the banks have just broken out to new multi-month highs. And I don't think we would see this much strength in the banking sector. If you go look at 2007, 2008, the banks actually peaked in about February, March of that year, and kept going down, even as the stock market peaked between July and October of 2007. So anyhow, we'll take a look at this. Tomorrow, actually, on Friday, I'm going to have one of my really interesting trades. I'm going to a blast in the past. I'm one of my favorite investors of all time, Jim Chanos, for when Chanos shorted Enron. So we're going to look at something kind of on the short side as a historic trade on Friday. And everybody take care. Have a great Thursday.